There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Okay, Matt and Tim here. We're going to be talking markets today, and we're going to be looking at quite a few different things out there in the market. We're going to look at the calendar. We're going to talk about the technicals, the potential breakout. We've got some live students here just for this version, and we're going to be answering your questions as well. Edgardo, Emily, Prem, Richard, Rosemary, and Vicky. Now, we must have lost Matt. He must have, not you, Matt, but Matthew, who's also usually here.
I think he had some audio problems.
Did he? He's probably relogging. The market conditions. Monday mornings are a great time to look at the markets. Many traders will come in on Sunday night. Some will come in Monday morning and start prepping and planning for the week. In general, Mondays are not historically crazy days in the market. Now, that being said, we've had some of the biggest days in market history on Mondays, as weekend news can have this huge impact if it's significant enough. But in most market conditions, it's not the biggest day. So, Matt, to answer your original question, as we were chatting, getting ready for this and talking, can the market break out? I think you have to consider the economic calendar before you can even answer that. If you would navigate towards an economic calendar, let's go through this point by point. All right. A lot of different sources out there for the economic calendar, Matt. I like Forex Factory. I like Forex Factory for a lot of reasons. You can get this calendar also on Tackle Trading through the Trade Center tab. But one of the main reasons I like it is that you can look at as many of the currencies as you want if you do trade currency markets. Or you can just filter it for the U.S. dollar if you just trade stock and options and commodities in the U.S. You can do what you need to. You can set the impacts you want, but even just a simple thing is that if you want to look at where the information's coming from or what the report is all about, there's a little folder you can click on and it will give you that information. Scan the calendar. Matt, let's do a little comparison. I'm going to take a pen and a pad out. I'm going to write mine down. I want you to write the two things on that calendar that you think are most significant. Tell me when you're ready. I'm going to write mine down as well.
Got him.
And I have mine as well. What's your? What did you put number one?
No, the most important report this week is the unemployment report. Mm-hmm. It's forecasted at 5.4. That's a couple things that is very important about the unemployment report. Number one, the Fed has stated for 5-6 years their quantitative easing policies, their monetary policy has a lot to do with the fact that unemployment has not gotten to the levels that can sustain a bullish market. And here's the biggest problem with the unemployment report being at 5.4, 5.5%, is we actually all know that the real unemployment number, if you take into account the people that have left the workforce because it's been so bad, Tim, that goes to the participation rate in the market, and that's at a 40-year low. So if you take into account the people that have voluntarily left the marketplace because there's just no jobs out there, it's actually 8.5 to 9% unemployment. So when you take into account the participation rate, when you take into account the sectors that have shown growth, when you take into account the demographics of unemployment, and you take that into in comparison with what the Fed's monetary policy has been, it's a very, very important report. Now, one thing I really like about this report coming up on Friday, it's going to be a great news-based trade in the currency market, T. Great news-based trade. When you have a forecast that is forecasted as the unemployment report to drop to 5.4% from the current one at 5.5%, that 5.4% is going to be built into the currency value.
Sure.
And so what's going to happen is when the report comes out at 8:30 a.m. Eastern Standard Time on Friday, that number, if it comes in anything besides 5.4%, say it comes in at 5.5% or 5.2% or 5.3%, whatever it comes in, that new number's got to be priced into the market, and it's going to move the market very, very, very fast. So I see the unemployment rate as the number one report this week The number 2 report I see this week, and then I'll let you kind of look at your list, is the ISM manufacturing.
You must have looked at my list. Hold on a sec. I thought I was going to get you with that PMI report. You must have looked at my list. Yeah. No, you're a true trader. I mean,
I've done this. I've done this for a long time. You would think it would be Fed Chairman Yellen giving a speech on Wednesday. That's probably what you would have thought I would have went with. But no, manufacturing, if there are 4 things, 4 reports that are probably more important right now than any other reports. It is unemployment, it is manufacturing, it is GDP, and it is the Fed FOMC meetings.
You know, and I think it's a very important point. And I will tell you, I'll even bring down my 3-year-old. She can't read, so I could tell her whatever's on this list, and she would confirm it for me. But I did have unemployment first. I had PMI second. I thought you were going to call it Yellen, just because anytime you see the word Yellen, your eyes roll to the back of your head.
They get red. Sure. They get red. That's true.
You know, and there's a lot on there.
Lockhart's giving a speech too. But, well, I just don't see, Tim, Yellen saying anything that she hasn't said before that we haven't heard a million times.
Well, that's the thing. The market knows.
I just don't see that.
The market knows where the Federal Reserve is, and the market knows what their position is. It's going to depend on data. And that PMI number, that manufacturing number, I think there's 2 reasons it's significant. Number 1, it comes early in the week, Matt. We're talking about technicals in a market, and we're going to go to the chart. We're talking about technicals in a market that were very bearish Thursday last week, rebounded Friday, rebounded Monday, but on light volume. We're now going to be moving into a Tuesday that I think could spark the volatility for the week. So I think there's 2 reasons why it's that important. But yeah, I had the same thing on my list. Manufacturing, unemployment. You start throwing numbers at traders, it's going to make them feel a little intimidated. What advice would you give beginners out there when they're looking at a calendar?
Do it every single day. See how it impacts the marketplace. Tim, I constantly get asked whenever how do you know so much about the economy? How do you know so much about the economy? And I'm like, guys, we get reports on them every day, And the first month you look at the economic calendar, it's crazy. It's nuts. There's so much to it. But if you can do it the first month, if you can go out there and you can track these economic reports, you're going to start to see which ones are important to the market and how they drive the market, and how some of the reports will have a bigger impact on the market than other reports will.
Sure.
And so when you're looking at manufacturing, Tim, over the last couple months, you've really seen some extremely negative economic reports. Extremely negative. We are now from an economic standpoint, we are now at the level of 2008. Our economy is as bad today as it was in 2008 when the market was crashing. And it's based on where these economic reports are. Manufacturing data has slowed significantly. Mm-hmm. We don't only get the PMI report, you get other manufacturing reports as well. Housing has slowed tremendously. I mean, you're talking about housing that is already starting to go down. And guys, if you remember the housing bubble back in 2006-07, the housing market started to turn around actually in late 2006, early 2007. It wasn't that it was 2008 and all of a sudden housing's going down. No, it actually started to turn before then. So housing has started to turn down. Tim, and it's not just here in the U.S. Canada, I just read a report yesterday that Canada has the most overvalued housing in the world, even higher than China right now. So you look at this and, from an economic standpoint, we're at recessionary levels, T. GDP report came in last week, and it was the worst in a year. It was at literally, we talked about this on the Coaches Show last week. I said, the advanced GDP number, I think that's going to come in between 0.3 and 0.5. That's where I've put it at. It was expected to come in at 1%. It actually even came in less than I thought. And guys, you got to realize something about this GDP number. It's actually going to be revised lower over the next couple of months. because of what we're seeing in the economic reports now, what we're seeing in the manufacturing today. I mean, look at the other PMI report from the ISM last Friday. It's at 51.5, T.
Yeah.
Anything below 50 is atrocious from an economics perspective.
But it's a funny thing, Matt.
The graph here over the last 6
I got to cut in on that for a second.
It's going getting less and less.
Yeah. It's interesting because even in China over the weekend, we saw a PMI number come in below 50, and the market rallied. And the headline in the news was, "Weak data in China propels the market upward." You're going to be hearing this phrase, good news or bad news is good news. Speak to that for just a minute.
It's the market's belief that, and it's at the institutional level, ladies and gentlemen, it's the market's belief that if the economy is atrocious, that the Fed will start QE4. That they will not raise interest rates, and they'll start QE4 because the market, the stock market specifically, is not correlated to the national economy. You would think that it should be, but it's not. The market only cares about interest rates. That's the only thing they care about is interest rates. And so when you have these rush of negative news out there, when you have the economy be bad, when you have the news coming out in China, weak Chinese data propels market forward, and that doesn't make any logical, rational sense. But it's again the belief that the institution at the institutional level, that if the economy shrinks, if the world global market goes into a recession, everybody out there, not just the Europeans, the Japanese, and the U.S., but the Chinese, the British, the Australians, certainly the U.S. coming into it, they'll all print more money. Now, let's go through this for just 1 second, T. Number one, they're mistaken. Okay, that they're mistaken, not based on QE4. I do believe that we will have a QE4 in the future. I do believe that the U.S. will go into a negative interest rate in the future. I just think it's after the market crashes. I think it's after the Fed raises interest rates and then cuts them back down. So I believe the Fed will raise interest rates so that they have ammunition to start a QE4. And also, two things here, and this is the craziness of all of it, T. Number one, if everybody's printing more money, ladies and gentlemen, it means the world will hyperinflate fiat currencies. Okay, and does everybody understand what a fiat currency is?
Fiat currency, what a name for it too, by the way. That's a T-shirt.
I love it.
I got to keep track.
Everybody know it. I agree. It's a fake currency. Okay, it's fake currency. It's currencies that are created. Like the U.S. dollar was created in 1913. The euro was created in 1992. It's paper money is what it is. It's not backed by any commodity like gold or silver or oil or food, right? It's just a paper creation. Well, the value of all these paper creations are only what the faith and confidence of the world to use them. Number one, and number two, the value goes back on the supply and demand of the supply money in the marketplace. So if you have everybody printing more money, it sparks inflation, and inflation at 2% can be a good thing. Inflation at 10, 15, 20, 30, 40, 50% is the death of currency. And that's only happened 75 times in the last 100 years. And so when you're looking at this, it's like has everybody in the world has lost their collective minds. In terms of this bad news is good news. It's utterly ridiculous that at the institutional level that they would rather see the world economy shrink and just go into an absolutely horrific recession because they think that all these people are going to print more money. That's ridiculous. It makes literally no sense from a fundamental perspective, but at the same time, that's what they're doing. And ultimately, when the Fed actually raises rates and breaks that mistaken belief, you might see the market, might be a spark to the gasoline to a certain extent.
Well, I'll tell you, I think it goes back to an old flaw in the entire Wall Street system where these bankers, Matt, who wear $2,000 suits and take the L train down to Wall Street in New York City, and they go to work at Goldman Sachs or Lehman, or what used to be Lehman, Merrill or whatever. Used to be Lehman, where they go to work, they don't actually make decisions for the next 5 or 10 years. They get paid bonuses. They get paid. They have their job based on ROI right now and ROI this quarter and ROI this year. And so even though they may, I mean, if you got those guys in a bar, had a couple of drinks, a beer and such, they're probably going to say a lot of the same thing, but it's not their money and it's not their problem, right?
Well, no, it's not. And you got to realize that if you know traders on Wall Street, and we do, if you know the traders at the institutional level, I'm not talking somebody who sells mutual funds. That's not, that's not a trader. Okay, I'm talking about the institutional traders for Goldman Sachs, J.P. Morgan, Bank of America, Merrill, the Deutsche Bank, Barclays. I'm talking that institutional level. When you talk to these people, they have one role in the market, guys. And what is it? What is the one role? Okay, one role that is for the traders in the marketplace. They only have one, and it's to make money. That's it. That is their sole role. Regulations, which are basically none. No regulations, no SEC, no care. They don't care who it hurts. They don't care about the ma and pa. They don't care about consumer society. They don't care about the growth in the national economy. They don't care about inflation. They don't care about devaluation. They don't care about anything that you and I care about from a monetary perspective, from an economic perspective, because they are solely focused on one thing, and that is making money in any way possible. And so when you have a pattern that's developed not only, Tim, over the last 3 months in the marketplace, but when you've had this pattern develop over the last 6 years in the marketplace, we've been living in this bad news is good news for 6 years now. And as long as that pattern maintains its viable nature, guess what's going to happen? These people are going to buy the negative news. They just are. And then they're not going to do that until they're not going to stop doing that until that pattern is broken in the marketplace. And the only time I think that pattern could be broken in the actual marketplace is only if the Fed raises rates.
Well, and when they raise rates, and they will eventually want to use that, is anybody's guess at this point. That's why the last few Federal Reserve meetings have been very interesting and why the dollar isn't responding well. You said something a couple of weeks ago that I thought was fascinating, and I do want to get to some charting here at this stage. That the dollar, the value of a currency, is the overall reflection of the strength of that underlying economy. And a lot of this weak data, well, the dollar has come back because of that. Let's go look at some charts, do some technical analysis for our audience out there, Matt. Let's look at
the main charts out there, the ones that you got to look at on a daily basis. And ladies and gentlemen, if there are 4 charts that you really have to look at every single day, it's the S&P 500, which is /ES. It's the dollar index /DX. It's crude oil /CL. And then I like looking at gold /GC. I think those are the 4 most important charts you need to look on a daily basis. I also like looking at the euro dollar on a daily basis, the VIX, silver, and anything else that you're actively trading out there as well. So first, I want to get your take on the S&P 500 as a whole. So far, up 9.5 points at 2111. It's got resistance overhanging at the 2120 level. And guys, when we talk about resistance, it's a zone. It's about an ATR zone. So you're really talking about 20 points of a resistance zone there, Tim. What's your read on the marketplace? We've already talked about it potentially breaking out, but what's your read on the marketplace right now?
Any breakout is a signal you have to pay attention to, but with a lack of volume and really seeing that the market has broke these mini resistance zones quite often, I think a breakout would even be short-lived until we get that news information, that PMI number tomorrow. So at this point in the day, like we're talking midday Monday, May 4th. May the 4th be with you, by the way, Matt. I heard that this morning. I wanted to...
Wait a second. Wait a second. May the 4th. Oh, my. Okay, keep going.
My kids told me that. So when my little Sammy says it to me...
If Sammy says it, that's cute. When you say it, you're I'm not even going to say, because I love Star Wars. I love Star Wars, okay? Love it. I am a Star Wars geek. I'm a nerd. And so I get it. I like it. I was just taken back by May the 4th be with you. It was just, okay, continue.
Well, I'll tell you, on Saturday, it was Sammy's birthday. Actually, your daughter was there as well, and we had a great time. And I bought her Lego Star Wars. So we've been playing Lego Star Wars over the weekend, and she's all about it. She loves the whole thing. I mean, that whole talk about Disney. I mean, that's a complete conversation. We'll have another time. I'll table it. But
I went on a 45-minute rant yesterday in Denver, Colorado on Disney.
Yeah.
So.
Yeah.
All over it.
Anyway, so here we are with the S&P. You know, by this time of day, the European banks are closed. And by the way, today there's a bank holiday in, I believe, London and somewhere else as well. So some of the banks are already closed anyway. And so you're not even getting some of the action you normally would. The volume's light. The volatility is low. 10 points on the S&P. It does look like a big green candle, Matt, but that's only 0.5%. I think 0.4 something percent. It's not a big move. You know, it's not a big move. And so any breakout, if you did catch it through the day, I would think would be a signal that you would probably pass on, because you need to wait for tomorrow's PMI number.
Today. Yeah. Especially on a Monday. And the reason I say that, ladies and gentlemen, is on Mondays, there's not a lot of economic reports that are very important that come out on Mondays. And so if in the morning you don't have the volume, you don't have the movement, you got to really ask yourself. It's 12:30. It's 12:30 on the East Coast. It's lunchtime over there. You really haven't seen anything happen in the market since the initial open here. This is the open right here, Tim. I mean, since the first 15 minutes in the marketplace, you really haven't done anything out there. There's been no volume. There's really just kind of hanging out. So unless in the last hour of the day, and that's in a few hours from now, unless you get a lot of big volume, I don't even care where the market goes, guys. I don't even care if it goes to 2100 or 2120 or 2125. If you do not have any conviction behind that movement in the marketplace on a day where there's nothing happening, then I'm probably not doing anything about it in that capacity. So, you know, it still has some room to break out here. To break out officially, Tim, I would have to say you would have to go up at least another 20 points to the 2130 level to actually call something a breakout. But is the market really going to move another 20 points on when there's nothing happening out there? I just don't see it.
I think a trader beta weighting their portfolio right now would probably call this a 0 or a +1. And if it does break out, you might get a little bit more aggressive after a retest, you know. So the way that you would kind of start planning this in your head is if the breakout happened, you would wait for a retest into intraday support or the old resistance, and then you'd probably look for an entry point at that stage. But technically, I don't think it's really set up that well.
Yeah, I want you to talk a little bit about when you said 0 to +1. Okay, I obviously understood what you meant, and I'm sure some people here in the lab knew what you meant, but somebody was probably maybe a little confused with it. So when you were saying 0 to +1, kind of go into a little bit more detail on that.
So if we imagined a world where you asked me my opinion and I answered it with a number instead of a description. That's what we're talking about first of all right here. It's called market bias, okay? It's called market bias. Write that down. Somebody write that down for me. Market bias can range all over the place, okay? So some traders are going to call it very bullish. Now, when I hear very bullish, I hear a +3. Some people will call it bullish. To me, that's a +2. Slightly bullish, that's a +1. Neutral, that's a 0. Slightly bearish, that's a -1. Bearish, that's a -2. Very bearish would be a -3. Now, if you ask me my opinion enough times over the course of a year, it's going to be distributed mostly like a bell-shaped curve. Okay, it should be that most of my answers are 0, 1, or -1. Every now and then it will be +2 or -2. And just once in a blue moon, it should be a 3 or a -3. Because market bias is a reflection of your conviction and your confidence as to what is happening in the market. I would say many days for me, Matt, are +1 lately. 0, +1, maybe up to a +2 on a real strong candle, back down to a 1, down to a 0. There are ways for us to keep track of this, and there are things that we need to look at as we're writing this stuff down. I actually think it's more important to keep track of your overall account bias and your account totals than it is any individual trade you make, because we can go back and look up individual trade information.
Yeah, it's absolutely those. If there's two numbers in a portfolio that are more important than others, it would be your delta, which is your bias, and your theta, which is your either positive cash flow or negative cash flow. So when Tim says 0 to +1, he's saying, okay, if this is where I want my ranges, somewhere between 100 and 400 if you're trading a $100,000 account. If you're trading a $10,000 account, that'd be, bring it down a little bit, down to, between 10 and 40 would your delta you would want. Right now in the marketplace, I am personally neutral in the market, so I am a 0, which means I want to carry a somewhat around 0 based delta. If it does break out, I'll switch to slightly bullish. Now, what is that in terms of the actual application of that? Because I think we all understand it from a theory perspective. But in the actual application, Tim, if we're neutral in the market and we break out and we want to shift to, say, slightly bullish, what would that lead you to do?
Well, I would change my overall account delta. This is a simple concept when you think about it, when you actually absorb it. But I can't tell you how many times over the years traders are misapplying the most basic concept, is that your portfolio should reflect the market bias and your opinions. That would make sense to me, Matt. It makes sense to anybody out there listening. Okay, yes, my portfolio should reflect what I think is happening in the market. But I'll tell you, many times I'll ask a trader, well, what do you think is going to happen? They'll say, well, it's probably going to go up. And then we go look at their portfolio and they have negative delta in their portfolio. And I'm like, well, why are you betting the downside, right?
Well, it's that's a great point. But, the amazing thing, though, Tim, is when I travel around the country teaching people, and introducing trading to these individuals, I always pull up the chart and say, hey guys, what's your bias? After I teach them how to identify trends, what is the trend doing? And they're like, oh, that's neutral. And I said, well, and I asked them a question: does your retirement account, does your portfolio reflect what you can see in the chart?
Yeah. And
the answer for them at that moment in time is obviously not. Because in their retirement accounts, I'm going to tell everybody what they are, and it's a guarantee. In your retirement accounts, if you are a passive investor and basically investing in mutual funds and whatnot, you are very bullish in the market. And that's the thing that they don't understand. They're like, no. I'm in some conservative mutual funds. Well, yeah, they only go down 50%, not 70% when the market goes down. It's like, come on, guys, all you're just buyers and you're very bullish, but in the chart you can see something vastly different. And so it's just, okay, let's read the chart and let's make sure our portfolio is moving in the direction of the marketplace. And so if we switch from neutral to slightly bullish, if it does in fact break out, at that point, that's just going to tell me maybe I need to take 1 or 2 short trades off the market. Mm-hmm. Maybe I need to add 1 or 2 bullish trades in terms of the market. So I would go out there and I'd scan or I'd go to Gino's options report or something, and I'd go add some bullish delta to my to the portfolio or take off bearish.
No question about it. And the analogy I use all the time, Matt, is that if you're running a portfolio, and see, by the way, if you're listening out there, you don't have to run a portfolio. There are plenty of traders who are net cash by the end of the day. They're called day traders. There are traders who use systems that are different from portfolio management. But the traditional investor, IRA traders, somebody out there using covered calls or naked puts or anything cash flow, is going to have a portfolio. And if you're running a portfolio, one of the simplest things you can do is tally up all of the math, look at the number, and you can actually hedge that risk. Guys, this is a very simple skill set once you're trained on how to do it. Talk to a mentor, work with them one-on-one. That'd be where you would learn that skill set. But the analogy I always use, Matt, is that you're not the quarterback of the football team. You're the general manager. Okay? It's your job to accumulate. We just recently had the NFL draft, so football's on my brain. It's your job to accumulate the right number of linemen and defensive, players and wide receivers and quarterbacks and kind of assimilate that group together. You're not the player on the field. You're the general manager. When something is happening in your portfolio, you need to take a few out or add a few in to get the right balance going.
Yeah, I agree. No, I absolutely 100% agree with that. In terms of balance, in terms of ratios on your trades and what. Questions, by the way, on the balancing the portfolio or delta weighting or, determining your bias in the marketplace?
Say that again, Matt. You cut out for just a second.
Oh, I was just asking anybody if they had any questions on, balancing bias in the marketplace, delta weighting and whatnot. Well, Richard, here if you go to the monitor tab, okay, and you hit this button here, okay, you'll have the new layout. If you hit it again and go to old layout, TOS adds up your net delta in your portfolio. So it does your theta too. So this portfolio would be on a $100,000 account, it would be, a slightly bullish bias, cash flowing 264 daily. That's what you would be doing here. Delta of 95. Well, yeah, your delta on the verticals, Eduardo, is a little bit less, but also in terms of you probably have bear calls, you probably have some condors there, you probably have some, bull puts, and that would probably be a good way to go about it.
Edgardo, what I would recommend is, we can keep talking about it here if the topic is not too big for our audience. I think it seems like people are pretty interested in it. When you're doing credit trades, Edgardo, sometimes you have to do what I call an overhedge. So if you have 95 delta and you're really worried about the impact of the market changing direction short term, and by the way, insurance, the way that you hedge and the way that you deal with portfolio insurance in this regard is it's kind of like if you lived in a world where you didn't have to buy car insurance for 6 months at a time, but you could buy it only on the days you needed it. And imagine if you looked at the news, you looked at the weather, and it said, okay, on Tuesday, May 5th, there's going to be a huge rainstorm. Or on December 22nd, we're expecting 6 inches of snow. Well, I might call up my insurance agent, which happens to be my mom, and say, Mom, I need extra insurance on the 22nd because I'm coming down to see you, right? So in trading, we don't have to have insurance all the time. We get and choose and when to put the insurance on. Now, this is a concept called an overhedge, Matt. If you're a credit trader, you're taking on what they call gamma risk. Now, that gamma risk can be calculated. It's in your portfolio as well. With some practice, and if you start looking at it, you'll understand it better. But Edgardo, simply put, if your delta says 95, that delta is going to go up if your trades move against you. Does that make sense? Okay. So to compensate for that rising delta as credit trades are moving against you, you might have to hedge in what I call the overhedge, where you pick up 150 or 200 delta against certain positions. And here's the key, guys. Put the insurance on when you need the protection, but take it off when you don't. You don't just leave hedges out there. Hedges are intended just to protect you for a short window until you get past a period that you no longer want to be in, because the best traders, Matt, are actually naturally hedged and they reflect their portfolio bias.
Oh, absolutely. Eduardo, kind of expand on what Tim was talking about. If you're primarily a credit trader, your biggest risk is to a volatile moment around news, economic report, major economic reports, FOMC policy statements, these types of news type events where I don't, where we have a higher degree of expectation of volatility in the marketplace. And so a standard hedge for something like that would be the day before the event, you put on a straddle on the weekly S&P 500 or the spiders or IWM or some market related ETF or something along those lines. Maybe even a triple leveraged ETF that you can get for cheap. You want to do something like that because that will add positive gamma to the portfolio, and that positive gamma to the portfolio will offset your positive theta risk. And so that's something, and it's not all the time, Eduardo. It's just when we expect a big movement in the market. Does that make sense? And that's kind of what Tim is talking about from a protection insurance perspective or a hedge. We always hedge risk, ladies and gentlemen. We always do.
And sometimes it's
on
planned,
earnings
Matt.
reports, we hedge.
Sometimes it's planned risk that you have to look at, like an economic event. Sometimes it's reactionary risk. If you have a portfolio where you have 20 or 25 positions and you come in and the market has been lit on fire and something bad happened in Europe or some weird thing happened, it's hard to just run out and get out of 20, 25 trades. It's a lot easier to add one position that protects that risk, right?
Oh, I absolutely. That protects that risk. And, guys, I'll just be as straightforward as I can here. The best traders don't just understand the U.S. marketplace. They understand when other national major economic events are happening as well, because we live in a global marketplace where what happens in China has a direct impact to the U.S. marketplace. What happens in Australia has a direct impact to the marketplace. And, that's why, I talk about all of the economic reports in the marketplace when I do the Forex report every week. I talk about all of them out there, not just the U.S. based ones. So, for example, in looking at this week, here's a list of all the major economic reports. Well, if I'm looking on Monday and Tuesday, okay, Sunday, Monday, Tuesday, I'm seeing AUD, 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 AUD. I'm seeing AUD. The Australian dollar is going to be in the news the early part of this week. You have trade balance tonight. You had building approvals, which was very good last night. You have on Tuesday. You have the Royal Bank of Australia announcing interest rates at 12:30 a.m. Eastern Standard Time. You have them announcing also retail sales earlier at 9:30 p.m. Eastern Standard Time on Tuesday. By the way, that's tonight. That's Tuesday morning. That would be tonight. They're announcing so it's 10:30 my time. So if I'm looking to trade, I'm thinking, okay, I gotta make sure that I'm looking at this information here. Because the Australians are going to be in the news this first couple of days. You have ISM manufacturing, like we talked about, for the U.S. You have trade balance for both Canada and the U.S. tomorrow morning. On Wednesday, you have your standard Yellen PMI reports for the pound. But for the Australian dollar, yet again, you have the unemployment rate that's supposed to come in at 6.2%. You also have the Australian monetary statement that comes out on Thursday. So they announced it today. They put a statement out on Thursday, and that's going to move the market as well. You also have on Friday, whenever the U.S. is reporting unemployment, guys, you can pretty much guarantee the Canadians are going to report unemployment at the exact same time. So when I'm looking at this week in the market, guys, the number one currency in the market that I'm looking at this week would be the Australian dollar, because there's so much information coming out on it, with number two being the US dollar and the US marketplace. But the best traders out there, they understand that to really be the best you as a trader, the best, the most informed, we have to understand that there's economic reports that happen elsewhere that impact the U.S. marketplace as well. Does that make sense, everybody? Okay. Emily, to answer your question, it would be in order to cash flow $5,000 a month. You take 5,000 divided by 30, and that's what your cash flow would be. So, what is 5,000 divided by 30?
About 170. So you probably need to target 200.
Yeah, if you do, your initial target, which again is 166, 170. Times it by 1.5 typically, you probably need a 250 theta.
Yeah.
Which to get 250 theta aggressively, you probably need to be allocating, I don't know, Tim, about $40,000, I would say, in credit spreads, naked puts. If you did it in covered calls, you'd probably need about 100,000 to get that theta up to where you want to be.
Yeah, and futures options probably give you access to the most leverage in theta, but you want to go conservative to start, though. You got to understand those risks before you ever start taking those on.
Well, I was showing people kind of that last week, Tim, and I showed them. Okay, so here's a leveraged one in the crude oil, right?
The June contract,
the June contract in crude oil. Got a good little 46.69 theta on 2,900 buying power. Now, the reason that's 2,900 buying power is because that's portfolio margin in the futures market. Okay, without that, that's probably a $40,000 position. And then these other ones are, like for example, here's another one I did with a big theta number, just to kind of show you. Was on the Russell 2000. It was an iron condor. 10 contracts on the Russell 2000. So it was a $10 spread. So a $10,000 position here got you about 50 theta. A $3,000 in portfolio margin. That's kind of what Tim was talking about from a leverage. Got you 46 theta. So two very similar trades right here, but because of margin, you could allocate less in the crude one versus the Russell 2000 here. Here's another one here, $5,000 position, as you can see. 39 theta. That's on a Priceline iron condor as well. So I just you like this one. This is why you don't hold through earnings, guys. I put on I want to say this was a bull put spread, okay, on LinkedIn. And guys, when we place virtual trades, we don't manage them. I was just showing some examples. Well, look, okay, profit loss from the open, $4,000. All right, that's because that's what happens when you hold a bull put trade through earnings, and it does this.
Mm-hmm.
So never do that.
It's funny, I tell people all the time, earnings are one of the most important things to double check. And one thing that if you're a thinkorswim user, you may not know how to do this yet, but I'm going to explain it right now. In your chart, offset the time axis on the right so it will peek forward for you, so that when you're looking at your charts, you can always see them. Matt, I'm looking at your chart right now as we're talking, and I know a lot of traders have those candlesticks hugged all the way to the right, and that's where they make some of their mistakes. This is probably just an oversight because you're in virtual, but just little things like that to help you stay organized.
Yeah, you definitely want to see the right of the chart.
Yep.
Definitely want to see the right of the chart.
I want to go through a couple of other charts real quick, Matt. I saw a position you had on crude oil. I want to get your take on crude oil. I have a big opinion on it. It's one of those major ones that you look at and I look at, and I think that everybody needs to look at. We've had a rally since mid-March. What do you see in that chart?
It has rallied from mid-March. I mean, you're talking crude now at $59 from the lows of 42.5. You're talking about crude going up about 18 points on 42. I mean, that's a big movement on crude over a month and a half. Really big.
From low to high, that's 40%. Yeah,
it's ridiculous. It's a huge movement. The biggest question everybody has is the sell-off over? Is that battle out there between the Sods and seemingly the rest of the world? I mean, I'm not even kidding. The Sods and everybody, it seems like. Is that battle now over, and did the Sods lose? Well, number one, the Sods cannot lose in any capacity, because even with high oil, they still make more money than anybody else. With low crude, they make more money than anybody else. It's a win-win scenario for Saudi Arabia. What Saudi Arabia was attempting to do with the liquidating of oil in the world marketplace, and what drove it down, Tim, they were looking to control their market share. That's what they were looking to do. They were losing market share to Syria. They were losing market share to Russia. They were losing market share to obviously the U.S. And they wanted to control the market share, and they also, wanted to kind of impact the cheaper drillers, that, the frackers from the U.S. and Russia specifically. And so they continued to liquidate the marketplace. Price action is king, obviously, and this is a short-term bullish uptrend. There's absolutely no doubt about that. There's a big reversal pattern right here as well, slowing momentum. I mean, this is kind of textbook technical analysis reversal, short-term uptrend now. But here's a couple problems I see in the crude market right now. And guys, I have naked puts on crude right now. So realize I'm just saying this for information purposes. Number one, Saudi Arabia has now hit a record of rigs that they have actively going right now. That's number one, Tim. And that is a big deal. When Saudi Arabia hits a record of active oil rigs pumping out oil, all right, that's a bad thing for the bulls on oil. Second thing, the U.S. released last week their oil inventory report, and they're approaching their inventories right now are very, I don't want to say they're full, but they're getting close to it. And as the U.S. continues to pump oil and not put it out there in terms of the world marketplace, that's going to become an issue. And so the question becomes, will the U.S. change that long-standing policy of not supplying oil to the world? I think that's debatable, but I would not be surprised if the U.S. lifts the regulations in some capacity in the next year or so to basically liquidate some of their own oil problems. Because once you're full, you have to pull back on supplying oil, which hurts the energy companies. And so you got these two issues happening right now, and I don't see the oil market not sustaining some type of downward movement in the future. I still think, coming down to the lows of 42, and I still believe getting into the 30s is a likely scenario. I just think right now, with the dollar showing signs of weakness, you've had crude respond very well. Right now, I don't know if I'm buying directionally, just because it's slowing its momentum on the way up. But I still don't mind selling naked puts and trading positive theta on it.
Yeah. Well, I think the supply thing is a very big issue. I think the international political landscape and also just trade landscape is also a very big issue. It's a complicated problem. The fact is the dollar's been dropping and showing some weakness, and crude oil's priced a lot in dollars, so it's showing strength. I've been calling it now for quite a few weeks, Matt, that $60 is the key resistance, okay? And it's just a psychological number. Sometimes as a trader, you're looking at the chart, you're trying to pinpoint the exact decimal point, but then an experienced trader is going to come back in and say, yeah, 58.27 is the exact tail of the candlestick, but 60 is the psychological level. Outside of the June contract, you're seeing prices at 61 up into 62 as you look further out into the contracts. The supply issue is a complicated one. Even with all that supply, we're still importing oil, though, which is interesting. We still need. We're using tons and we still import tons. It's a funny thing to look at it that way as well. But yeah. I'm short-term bullish until otherwise noted. You see the trend from mid-March until now. And you've got a clear trend line. You have a clear trend line. If support broke on volume on a bad report or the dollar rallying or something like that, we would see it and we would respond. This is probably the best example of the trade what you see mentality that I can think of in the last little bit. Because if I was going to trade my opinion on oil, I would probably short it. But trading what I see in the chart, I mean, it's still showing strength.
Well, and Tim, that's why I said, I'm going to talk about this, but you got to realize I have naked puts on crude oil right now.
Yeah.
Because you always trade what you see. You don't trade what you think. What you think just simply allows you to be aware and prepare for certain eventualities and so on and so forth. Crude is good right now. And by the way, I always laugh at when I see some other trader say, support's right there at 58.28. They just really to the penny at 58.28. When any true technician understands that everything is a zone, and the psychological levels around those zones are very, very key. Like your call at $60, and it's just, guys, it's just our human nature. We have a tendency to gravitate to the round number. And so when the technicians are looking for, resistance and support areas, they'll go to round numbers. It's just a psychological zone. And then you'll look at prior pivots and other levels too. But again, it is just a zone. So crude oil right now, I like your call on the bullish side of it. Be careful around the $60 mark. If we see some momentum above 60, then obviously you can see some movements there as well. I wouldn't be surprised if we hang out between 57 and 60 for a bit, but we'll see. I like naked puts on it though. That's definitely. Tim, dollar index here. Got the Forex report coming out later today. Have not done it yet, but I'll probably call for a little bit of a dollar rally up back into resistance. And I think the most important time in the dollar's very important short-term history is whether or not it can get back up above 97. If the dollar can't get back up above 97, Tim, you might see this run over on the dollar, and we might be getting ready to pile up on the short-term sell side on the dollar. So also, if the dollar can't get back above 97, look for oil to break out of 60. That could be a combination trade there as well.
I say it all the time. It's the first domino in the domino effect. And what you guys are looking at here is the dollar index. And the dollar index is the measure of the dollar against a basket of currencies, most notably the euro, but also the yen, the pound, the Swiss franc, the Aussie, the CAD, I believe the New Zealand dollar. I'd have to look up to know exactly which ones are indexed here, Matt, outside of that. But you're seeing a little bear retracement. When you hear 97 on the dollar index, what that means is that the entire value of the dollar against all of those currencies is about 97. Okay. Now, when you're looking at a currency swap pair, or you like the euro dollar, the pound dollar, you're going to see a different number, like 113.22 or 1.5417, something like that. Those are in pips. This index is not in pips, it's in pennies, because they're actually futures products that you can trade behind it. I'm with you. I actually think that it's probably more bearish than we're even admitting right now. It broke below support on some pretty heavy pressure. You've got that old support point at 97. That could be a kiss goodbye pattern developing, Matt. Well, we'll know more with the PMI number and the unemployment pattern later in the week. Those data points could drive that.
Well, here, and I've been talking about this for a month now. When I called for the dollar to initially get into the $100 level range, and about 2-3 months ago, after the $100 target range was hit, my projected out at 110, 113, and that was based on the economic values of what we were seeing at the time. But Tim, over the last 2 months, we've seen some very, very negative economic reports from the U.S. And even myself, I was a little surprised that we were going into a recession at that point. And we're technically not in a recession yet, ladies and gentlemen, but I do believe the revised GDP number will be under a negative based on the economic reports we've seen so far. And I do believe that this is going to have an impact for the U.S. next quarter as well. Next quarter is, if it comes in under zero next quarter, it's a recession, done, and you will see the market sell, done. Okay, but right now, the economy really struggled over the last couple months, and the dollar's reflected it. Because if you want to talk about correlation, in terms of correlation, the currency, and not just the US dollar, but all currencies are a more tightly correlated instrument to the status of an economic of an economy more than anything else is. So when the US economy struggles, the US dollar is going to go down and other currencies are going to go up. And so the dollar right now, I say 97 because 97 was this major support level right there. It tested it numerous times. If you see a rally back into 97 and it can't break it, that's going to be your little kiss goodbye, kiss of death pattern. That would be a very powerful bearish one. If it does get back up above 97, that would just be neutral. But right now, Tim, you have to call a slightly bearish trend on the dollar. I mean, there's no other way to put it. You have to call that. It's just because, I mean, you got a breaking of support on strong volume. We talked about volume earlier today. Look at that volume on the breakdown right there. Boom, boom, boom. That was on GDP report last week, ladies and gentlemen. When we got the GDP, everybody's like, okay, dollar's done. It came in at a negative number, but now it's kind of overextended to the downside here, and that's why you're seeing a little bit of strength coming back up. This movement back up is not a bullish sign, especially when you have the volume you have here. It's kind of the opposite thing of what the market is doing. This is just profit taking on the short side here. It's just people buying at a low when they normally do, and that should drive it back up into 97. But we'll kind of see it. We got a major week coming up, and I wouldn't do anything until we saw the manufacturing report tomorrow, though.
Absolutely. I think that's a good one to look at. It's been a fun conversation, Matt. I always enjoy sitting and chatting with you. I know we haven't been able to chat for a few days, so this is actually the first time we've been able to look at the market together here for this next week, and it's exciting to look at. I'll tell you, we talk about currencies, we talk about commodities, we talk about all these products. One last one I want to talk about before we close up. I know we're running long with our group here, and we got to get them out of here. I want you to look at the VIX real quick. And while you bring up the VIX, I'm going to give a read on the VIX here in just a minute. But I will say this. Guys, even if you don't trade those products, I think to be a well-rounded and informed investor, even if you just trade your ETFs or your IRA or your stocks or your credit spreads, watching the dollar, crude oil, gold, volatility, these are major market indicators, okay? They're not only products, they're indicators, and they can really help you understand what's happening out there. Volatility. The one thing that is really kind of against all the risk that we've been talking about, the reflection of economic problems and all that, is, Matt, when it comes down to pricing risk in the options market, it's still at historic lows. Why do you think institutions are not interpreting the risk that we're seeing and making options more expensive?
Well, it's been at lows for a very long time now, but I don't know if there's a direct correlation between what the institutions think and what the VIX is saying, though, T. And I'll tell you what I mean. Okay, when you look in the marketplace and look at 2013, market goes up 30% in 2013. You look at the marketplace in 2014, the market goes up, 12% in 2014. Mm-hmm. In 2015 so far, when you're talking about the S&P 500, 2015 starts right here. Okay, so you're talking about the market being up about, what would that be, about 4%, 5% right now? Mm-hmm. 4 to 5% in the S&P 500. That's slowing momentum in a nutshell, is what that is. And so the market, I think, is starting to price in some risk, simply because they're not buying. But the marketplace hasn't started selling yet. We've just seen a less buying mentality. It hasn't started selling yet. And you also got to realize this, guys. The VIX goes up really, really, really fast. It does not go up slow. And so the VIX can spike very, very, very quickly. And just because, let me put it like this, T. The market's at the all-time high. It has not broken a support level, okay? Why would the market price options higher when there's really no risk today.
Yeah.
Or tomorrow for that matter.
Right, and they just haven't seen significant selling pressure. You know, the thing about the VIX is it's a reflection of where they can make money. Markets would love to make options more expensive, I'm sure, you know, increase the bid and the ask and all the volatility that comes with it. They can't justify it because they'll get pounded by the sellers. If you increase option prices, sellers are going to come in and sell them. And that's what's happened to them in the past. That's why you see any of the spikes very short-lived, because until market, you know, realities actually play themselves out and start selling off, we do just see kind of a slowing momentum uptrend in the overall market. The VIX will spike when the market actually sees the risk.
Okay, so the two biggest VIX spikes in the last 6 months were October of last year and December of last year. Okay, so the VIX spikes because the market starts to go down. The VIX doesn't spike as it's slowing momentum. It spikes as it goes down. And so once you break this support level right there, the VIX spiked really, really fast. Okay, market's going down again, VIX spikes really, really fast. And so, like, for example, you were at the exact same lows that you are today pretty much in September, and within literally 2 weeks, the VIX spiked 200%. You know, and that's why I said the VIX, once it breaks support, guys, it spikes really fast.
Mm-hmm. Yeah. That's a wrap for us today, Matt. Enjoyed it. Everybody. You know, get on the forums, ask your questions, follow up with us. You know, there's the clubhouse is back up and running at Tackle Trading. If you want to go post some questions there, watch for the Forex report later today, and just a lot going on. You know, the PMI report. It'll be interesting to react to that tomorrow, Matt. All right, guys, enjoyed it. We'll talk to you guys next time.
Later, everybody.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice Podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.